Hi, John here. In this video, I'm going to discuss how high income earners in Canada can stop overpaying their taxes. We'll discuss a number of strategies so you can pay what you owe in taxes and nothing more. A critical part of building wealth is saving and investing. So if you can save on your tax bill, you get your goals much more quickly. I'll cover 5 different ways Canadian high income earners can reduce their taxes. Stay to the end where I'll cover one of the most confusing parts of the mix. That's figuring out your cost base. My name is John Woodfield. I'm a portfolio manager and financial advisor with over 30 years experience. Each day I speak with clients, and often concerns around taxation and capital gains arise. The more you make, the more important it is to work with a high quality team of financial professionals. This will include a chartered accountant, a portfolio manager, and potentially a lawyer. This video is not a substitute for high-level help for the high net worth in Canada. What we will do, though, is we'll go through 4 ways that we can help you protect your hard-earned money. The first way to significantly reduce your taxes is through the Dividend Tax Credit. Fortunately, the Government of Canada and CRA has created a system whereby the taxes that a company pays are credited back to you as an investor in that company. So you don't pay taxes on the whole dividend that comes in because of this credit. This helps you keep more of your hard-earned money in your pocket. The next way you may be able to reduce your taxes is to deduct interest that you've taken out on investment loans. Here's the idea. You buy a stock or something that creates investment income and you borrow money to do so. The interest on the money that you borrow is deductible from your taxes. The next way you can possibly reduce your taxes is through the deduction of your wealth management costs. Let's say you're working with a portfolio manager who charges you a 1% cost. This is not only to manage your money, it's to do a variety of other services, such as financial planning, wealth advisement, and potentially estate planning. Fortunately, the government allows this 1%, in most cases, to be fully deductible against your taxes. Let's say you have $4 million invested in your taxable non-registered portfolio, and it goes up 6%. That means you're up $240,000. Of course, you've had a 1% charge to the portfolio manager, which in this case amounts to $40,000. This is fully tax deductible. So in the highest tax bracket in Canada, this is reduced to below $20,000. So you've made $240,000 on your portfolio and it's cost you only $20,000. Costs for things like mutual funds or exchange traded funds are not tax deductible. Only costs for portfolio management is tax deductible. So those of you who are investing in mutual funds, exchange traded funds, RRSPs, TFSAs, unfortunately do not have the benefit of tax deductions. If you're investing in a mutual fund with a 2% management cost, none of that cost is tax deductible. This is why we recommend people work with a portfolio manager if possible. Portfolio managers are fiduciaries and have the ability to create a well-balanced portfolio, which is essential for high net worth individuals. The next way you can minimize your taxes is by closely and accurately monitoring your cost base. What is a cost base, you may ask? Well, when you initially buy your shares, of course there's a cost to buy them. But each year, if you get dividends and you reinvest those dividends, that amount is added to your initial purchase price, and every year your cost base grows. This is often shown as what's called book value on your statement. It's an amount much larger in most cases than what you initially invested. The idea here is when you initially bought and the dividends all add up to a cost base or a book value. When you sell, you subtract that amount from your sales price and only pay tax on the difference. Let's say, for example, you invested $1 million in a portfolio of stocks, and over the following few years, you had $150,000 of dividends or realized capital gains. So your book value is now $1,150,000. If you subsequently sold the whole basket of stocks for $1,500,000, you would have a capital gain of the difference between the $1,500,000 and the $1,150,000, which is $350,000. From this $350,000, since capital gains are only 50% of the capital gain is taxable, you would have $175,000 of income that would be taxed to you at your personal tax rate. But be warned, tracking and monitoring your book value can be complicated and confusing. Fortunately, good financial advisors and portfolio managers have mechanisms to track this for you, and you can utilize your accountant to make sure that you get this right. Now let's go over another way to reduce your tax in Canada. Actually, let's go through two separate ways. The first is a TFSA, or tax-free savings account, and the second is an RRSP, or Registered Retirement Savings Plan. A TFSA is a system where you can invest money that you've already paid tax on, of course, because you pay tax on your income, into a plan where you pay no further tax. This means that any money you put in, any gains that are made in there, you can take out anytime, fully tax-free. Of course, there's no capital gains treatment, etc., because it is tax-free. And also, if it goes down in value, you don't get to utilize the capital loss. But other than that, you're free and clear of taxes with the tax-free savings account. RRSPs, on the other hand, are used to reduce tax in the present because whatever you put into an RRSP is taxable against your income. The idea here is to save the tax when you're in a high tax bracket and take the money out of your RRSP at a future date when you're in a lower tax bracket. Finally, if you're considering a cross-border move or you're already living in Canada, I recommend you contact us and book a call with a Swan Wealth Advisor. Thanks again for watching, and we'll see you in the next video.